Diversification is your key to managing risk in the unpredictable world of investments. We'll explore why it's so important and how to build a balanced portfolio tailored to your needs. What is diversification? Imagine you're carrying a basket of eggs. Would you put all your eggs in one basket? Of course not. If you drop the basket, all your eggs break. Diversification is the same concept, but with your investments. It means spreading your investments across different types of assets, like stocks, bonds, and cash. This way, if one investment breaks or performs poorly, the others can cushion the fall. Why diversification matters? The market is like a roller coaster. It has its ups and downs. No one can predict exactly when it will rise or fall. If all your money is invested in one stock and that stock plummets, you could lose a lot. But with diversification, you're not putting all your hopes on one single investment. If one investment underperforms, others in your portfolio may be doing well and can help balance things out. It's like having a safety net for your investments. The importance of risk management. Think of diversification as an insurance policy for your investments. It helps protect your portfolio from unexpected events and market downturns. By spreading your risk, you increase the likelihood of achieving your long-term financial goals. The core principle. Think of a seesaw. To keep it balanced, you need weight on both sides. Diversification is about creating that balance in your investment portfolio. You want to invest in assets that react differently to market changes. So, when one side of the seesaw goes down, the other side may go up, keeping your overall portfolio more stable. Asset classes, the building blocks of your portfolio. Let's talk about the main types of investments, or asset classes. There are three primary ones: stocks, bonds, and cash. Each asset class has its unique characteristics and risk profile. Understanding these will help you build a diversified portfolio. Stocks. Potential for growth. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. Stocks offer the potential for high growth as the company grows in profits. However, they can also be quite volatile, meaning their prices can fluctuate significantly. Bonds. Stability and income. Bonds are like loans you give to a company or the government. In return, they pay you interest over a set period. Bonds are generally less risky than stocks but offer lower potential returns. They provide stability and a steady stream of income to your portfolio. Cash and cash equivalents. Safety net. Cash is the safest asset class. It includes things like savings accounts, money market funds, and certificates of deposit. It's very stable, but it usually doesn't grow much. Cash acts as a safety net for your portfolio, providing liquidity and stability. Risk tolerance, knowing your comfort level. Before you build your portfolio, it's important to understand your risk tolerance. Risk tolerance is how much risk you're comfortable taking with your investments. Are you okay with the possibility of losing some money in exchange for the potential for higher gains? Or do you prefer to play it safe and prioritize protecting your savings? Factors affecting risk tolerance. Several factors influence your risk tolerance. Your age is a big one. Younger investors generally have a longer time horizon to recover from any losses. They can afford to take on more risk for the chance of higher returns. Older investors, closer to retirement, may want to focus on preserving their capital and opt for lower risk investments. Other factors to consider. Your financial goals also play a role. Are you saving for a down payment on a house in a few years? Or are you investing for retirement decades from now? Your financial situation and personality also matter. If you have a stable income and are comfortable with market fluctuations, you may be able to handle more risk. Portfolio for low risk tolerance. If you have a low risk tolerance, you might prefer a portfolio with a higher allocation to bonds and cash. These investments provide more stability and are less likely to experience dramatic swings in value. This type of portfolio is often suitable for those nearing retirement or those who prioritize protecting their savings over pursuing high growth. Portfolio for moderate risk tolerance. A moderate risk portfolio aims for a balance between growth and stability. It typically includes a mix of stocks, bonds, and cash. This approach allows you to participate in the potential growth of the stock market while also having some downside protection from bonds and cash. It's often a good fit for investors with a longer time horizon and some willingness to accept market fluctuations. Portfolio for high-risk tolerance. If you're comfortable with more risk and are seeking higher potential returns, a high-risk portfolio might be suitable. This type of portfolio has a larger allocation to stocks. Stocks offer the potential for significant growth over the long term, but they also come with higher volatility. High-risk portfolios are typically best for younger investors with a long time horizon who can withstand market downturns. Beyond asset classes. Diversification isn't just about spreading your money across different asset classes. You can also diversify within each asset class. For example, within stocks, you can invest in different sectors like technology, healthcare, and energy. You can also diversify geographically by investing in companies from different countries. This adds another layer of protection to your portfolio, reducing the impact of any single sector or region underperforming. Rebalancing, keeping your portfolio on track. Over time, some investments in your portfolio may perform better than others. This can cause your portfolio to drift away from its original allocation. Rebalancing is the process of periodically adjusting your portfolio back to its target allocation. It ensures that your portfolio remains aligned with your risk tolerance and investment goals. The benefits of rebalancing. Rebalancing helps you maintain your desired level of risk. It forces you to sell high and buy low, a key principle of successful investing. It can also improve your portfolio's performance over the long run. Professional advice. Get expert guidance. Building a diversified portfolio can seem overwhelming, especially if you're new to investing. Don't hesitate to seek professional advice from a financial advisor. They can help you assess your risk tolerance, create a personalized investment plan, and guide you through the process. Diversification is a fundamental principle of smart investing. By spreading your investments across different asset classes, you can minimize risk and increase your chances of long-term success. Remember, there are no guarantees in investing, but with a well-diversified portfolio, you'll be better prepared to weather the market's ups and downs. Need to keep your screen looking busy? Sign up for our free email newsletter. Don't forget to like, subscribe, and get notifications for more 5-minute fixes.